Welcome to a special edition of Indianomics. The world is in the midst of several global skirmishes. There is the huge Middle Eastern conflict, two of them actually, in Israel and Gaza, and Israel with Iran. We also have, of course, the major global trade war going on. And today I have with me an expert who will be able to disentangle and help us understand all these skirmishes and questions far more clearly. I have with me Martin Wolf, the chief economics commentator with the Financial Times. Needs no further introduction. Just a word of thanks to the NCAER for allowing us to make this happen. Mr. Wolf has been invited here for their India Policy Forum. Thank you very much, Mr. Wolf, for joining us.
It's a great pleasure.
Well, first up, we're all fixated with July 9th. The April 2nd reciprocal tariffs took all stock markets down. Now we are just a few weeks away from July 9th when supposedly those reciprocal tariffs will reappear. Hardly any country has been able to sign anything with the United States. So should we expect another major downturn and crisis, or will it be taco?
First of all, I think the crucial thing is I don't know. And I have a very strong suspicion that nobody knows except possibly Donald Trump, and I suspect he doesn't know either. So we're making guesses. So there are things we know. It was never going to be possible. It was absolutely inconceivable that America would be able to reach deals which were concrete deals within that period. It's never happened in the history of trade policy. It normally takes years to complete a trade deal. Think of how long India and the UK have been doing it. Many, many years. The idea that you could do it with 200 countries or even 100 countries in 3 months was complete fantasy. On the other hand, I think it's also inconceivable after the tremendous shock and the relief when he withdrew these tariffs and the subsequent huge shock, the one big shock of the China trade war, which he also stopped. It seems to me inconceivable with all that's going on in the world that Mr. Trump will want to start this panic over a level of tariffs which will basically stop world trade. So my assumption is they will announce one or two successes, which will not be completed deals, but indicate things are going in the right direction, and that they are negotiating seriously. And they will say this particularly vis-a-vis important countries like India. They've already basically agreed with the UK. I suspect that will happen with the EU and a number of Japan, other important allies. And they will say, we are negotiating with these countries, will continue. I suspect they will also sort of forget about a lot of the smaller countries. They will just have a 10% tariff because that's already much higher than before. And they will never really pursue negotiations with Lesotho and all that. And so we'll just get used to the idea. These negotiations are going on. At some point, they will or will not be completed, but trade will basically go on, even though, of course, even as things are, average US protection is very important, is higher than it has been at any time since the 1940s. So it's very protectionist and it will affect world trade. But I find it inconceivable that they're going to impose or reimpose all those tariffs. So I'm relatively optimistic that peak craziness, still the cost, but peak craziness has passed.
Well, that's what the financial markets are banking. Let me first get the India questions because that's what our viewers will want to hear from you. Do you think India looks in a particularly advantageous position because of Donald Trump's and America's dislike of their dependence on China? It looks, almost axiomatic now that India may have maybe 10, 12, 15% tariffs after the negotiation, but China will be at 30, 35%. Yeah. It doesn't look like it will be any less than that. So does that big 20 percentage point tariff difference make India an attractive destination for textile companies, for Nike, for Adidas? Will investments come?
Yes. There's an upside and downside. Mr. Trump has reintroduced what trade policy analysts call discrimination into trade policy. And this is one of the most obvious ways in which he's broken fundamental principles of the WTO. But if you have the benefit of discrimination in your favor, That's obviously good for you. So potentially this gives India an opportunity to expand its exports of products which compete with what other developing countries can supply, and make it a more attractive base for foreign direct investment, particularly by US firms. And this is reinforced by the sense that the Trump administration and America more broadly looks more favorably on India politically than it does very clearly on China. So these are assets for India. The questions, however, are always the same. One, do outside investors find India a really attractive place to put investment? And that depends on the quality of infrastructure, the quality of labor, the way Indian legislation and labor markets works. Do they feel this India is now a place we can operate increasingly as we can in China? And I would say that's beginning, but we're not there yet. So there's the domestic base. And then, of course, the other thing is they have to say to themselves, okay, we've seen all this instability in trade policy. If we're going to set up a new factory, that's a big investment. We will need 5 to 10 years to get it back. So we don't need to know just, do we have the preference today? We have to know, how long will it last? Now there's a reasonable bet that India will be favored over this period. But trade policy can change, as we've seen. So the investors will. So the big thing that Trump has done in trade policy, by breaking all the rules, he's injected profound uncertainty. What you're seeing and what you're getting here is based on the whims of one man. I would say India is in an advantageous position. It's an important country. The Americans recognize this, but you also have to recognize the president is a very impulsive and unpredictable man. So I would say you can't be completely sure of it. And that I emphasize the fundamental resource of a developing country is its competitiveness. Relying on tariff privileges rather than being actually the least cost producer in the world, which is basically what China has become, is a bit risky, and I wouldn't push it too far.
Fair enough. Things are moving in the right direction. We've seen a reduction in taxes, a reduction in interest rates, cost of capital coming down. I mean, there are several things working.
There are a lot of things that have happened. India is incomparably more competitive than it was 20 years ago. This is obvious, but that remains very important. You cannot just rely on the idea that America doesn't like China, will lock it out of its markets forever. Things can change.
Okay. Well, I must get the all-important dollar and yields question out of the way before I come and discuss China and Middle East with you. The dollar has been consistently falling, and that appears to be because of a dislike for US treasuries and the high yields. Do you think this is going to be the trend, considering that there is this big, beautiful bill, and that will mean more treasury issuance and therefore higher yields?
Well, I don't think you should just look at treasuries. The US has a very large current account deficit. The main counterpart of the deficit is the fiscal deficit. And so they are linked. Yes. What this means is there has to be a very large net purchase by the rest of the world of US assets. Now, one of the interesting things which is not much noted is in the last 10 years, foreign currency reserve accumulations have stopped. So the big expansion was from about 2000 to about 2015. So the governments of the world are no longer large net buyers of currency assets as reserves. They're buying gold very clearly. You can see that very clearly. That's diversification of their reserves. They don't want to hold, in other words, and the dollars are about 60%, slightly less. So they're basically saying, we've got enough dollars. So that means that huge deficit has to be covered by the private sector. By definition, or parastatal organizations like sovereign wealth funds in the Middle East and so forth. And they're looking for commercial return against risk.
Yes.
It's a slightly different thing. It's not just we must have these reserves because it's safe.
Yes.
They're looking for commercial turn and risks. And their problem is given the huge deficits, there's a very considerable chance the nominal yields will rise further. They are very concerned, I think, in addition, that inflation will rise because there's a lot of pressure from Donald Trump on Mr. Powell, the Fed chairman, to lower rates when inflation is still quite high and the fiscal program that they have is considerably expansionary, so it might get worse. So that would mean that nominal yields should go up, but the Fed might fight that. And all in all, buying long-term treasuries in a country which has very high public debt, very high deficits, very high, which is funded from abroad, crucially, a third of treasuries is owned by foreigners, it just looks risky. And then there's currency risk, exchange rate risk. So I suspect markets will be saying, we want higher yields to compensate for this risk. But then they start saying to themselves, well, if the yields go up, that makes public finances in America even worse. And then that's a vicious circle. So the sensible thing to do is we'll hold cash. We go short term. If we hold dollars, we hold short term. Then we at least can get out easily. And we can get out without paying a capital loss when we sell the bonds. And this is pretty clearly, they're being pushed to the short end of the yield curve. And that makes management of public debt in America really tricky. And it's obviously worrying the US Treasury a lot. And they're thinking, they once even said, we're going to force people to move much longer on the maturity, up to 100-year bonds, which again makes people frightened. I think we may be reaching sort of semi-satiation point from the point of view of global investors in long-term US Treasury debt because it's too risky, and raising the yields doesn't get rid of the risk, it just shifts the nature of the risk. And that's not a very good bargain. So I think US fiscal policy and monetary policy, given their external dependence, is at a very vulnerable state.